if you talk about the overall picture, there is one where technology is obviously the talk of the town right now. It's the most important sector out there, and it's gotten hit the worst. Is this a time now that worries you because that all-important sector is the one that's the worst performer out there?
No, it doesn't worry me, and quite frankly, it's to be expected. And quite frankly, I think that we will retest the lows that we saw in June, if not see levels a little bit less than that. And there are three reasons why. Number one, we are embarking on a quantitative tightening program that is a lot more aggressive than we've seen in the previous months, and that's going to drain liquidity out of the system and put pressure on equities. Number two, estimates need to come down. We're looking at about 60 in the back quarter. We're looking at about 246 in consensus for 2023, and both of those are significantly over where I think we'll actually see estimates come in. And so in the midst of that downward revision cycle, particularly as we start to look at 2023, you'll obviously, that'll be a headwind. And the last is that for whatever reason, we continue to debate what the Fed is going to do. And I think that they've been quite clear about what they're going to do, particularly in light of the persistence of the inflation we're seeing. They think that the right policy rate is around 4% on the Fed funds rate. So that implies another 1.5. We could very well see a full point in September as they try to move that forward rather than have this creep into next year. So all three of those things will continue to put pressure on the markets, and I think we will retest those lows.
It's fair to say, Greg, that many of these economic stories and market-specific and company-specific stories are all intertwined in some way. But in your mind, I'm curious whether or not you feel as though the bigger threat from the interest rate picture is on the valuation side, the mathematical side of things, or whether or not it's because higher interest rates will inevitably slow down the overall economy, which hurts just about everyone.
I think there's a threat from both, quite frankly. And as you intimated earlier, growth, particularly non-profitable growth, but all growth, will feel the ramifications more so than the rest and have already been feeling those ramifications as the market came to a consensus that we're going to see 75 bips, if not more. But yeah, I think the threat is to both. You know, obviously the Fed doesn't have a precise formula. They are reacting to lagging indicators to some degree, and they're trying to get it right. I believe that will be difficult to do. So it's both. You'll have the decreased liquidity effect, the access to credit effect, as well as the slowing economy effect.
All right, let's talk about the ideas now. Given that economic environment, given that outline that you've kind of put out there for us, right, what exactly is the opportunity? What's on the shopping list, or what are you staying away from?
You look for two things. You look for inelastic demand and secular tailwinds. In terms of inelastic demand, things like hospitals, things like energy, regardless of what kind of macro environment we're in, regardless of what kind of economy we're in, those things tend not to see their top line suffer. Even some mobile, right, like T-Mobile, Verizon, AT&T, although there's a vast value disparity between those are safe havens. The other thing you're looking for is secular tailwinds, things that are tethered to changes that can sustain earnings growth even in a challenging macro environment. And so there are some tech names, it's particularly those tethered to the cloud, that will continue growth. There are even some credit card names, although I'm very cautious on the consumer in the back half. We have this transition of going from paper to plastic. And so you've seen the credit card companies do very well during the summer of spend, and that should continue for a few months here.